Okay, this is the accounting rate of return. And it really wants to see what's the impact of the project going to be on the income statement. It's sort of what it's looking for, okay, in a slightly modified way. But you take the average annual operating income from the asset. Okay, so it's average annual operating income. All right, so if you're looking at maybe a 5-year life, you take the total income over 5 years and divide it by 5 years, and that would be your average annual operating income, and divide that by the initial investment. So it focuses on operating income, okay, not net cash inflow, but it does make some adjustments. It's based on accrual accounting, so you know that if you look at an income statement, you're looking at an accrual-based statement, all right? That's not cash. However, it does subtract non-cash expenses from net cash inflows to get an operating income. So what we do generally is subtract depreciation. So the formula for it is the average annual net cash inflow minus the annual non-cash expense divided by the initial investment. Okay? So here's an example. This is the AC system, which cost $240,000, had equal annual net cash inflows of $60,000. Okay? A 6-year useful life and no residual value. So the first thing you'd want to do is figure out what the annual depreciation was on the asset. So our investment is $240,000. It has no residual. We'll just use straight line. We'll divide that by the 6-year life, and we get depreciation of $40,000 a year. Okay? Then compute the accounting rate of return. So my equal annual net cash inflow is $60,000 minus depreciation of $40,000 divided by $240,000 gives me an ARR of 8.33%. Okay, so that would be like the impact of it on the income statement. Now here's the other example. This is the production equipment with unequal net cash inflows. Okay, so the cost was $240,000, unequal annual net cash inflows, a 6-year life, and a $30,000 residual value. Okay, so that residual will affect your depreciation calculation. So the average net cash inflows are $360,000 divided by 6 years. Okay, so that was I think that's the total, 360 divided by 6 years, so that's $60,000 a year. Our depreciation would be the cost of the asset, $240,000 minus a $30,000 residual, gives us $210 divided by 6 is $35,000. Okay, so that's our annual depreciation. So the accounting rate of return would be that average operating income of $60,000 minus depreciation of $35,000 divided by $240, your investment, and that's 10.42%. Okay, so you'd have some kind of a hurdle rate that you'd have to beat for this in order to get be approved for the project. And that's the decision rule. Should you invest in capital assets? I've never seen the accounting rate of return, though, used in any kind of decision, for what it's worth. I think it only exists in accounting textbooks. So if the expected accounting rate of return exceeds the required rate of return, you'd invest. If it's less than it, you wouldn't invest. Not quite rocket science, huh? So I'll do some problems with you after this.